As Johnny's going to be covering information, feel free to put anything here on the group chat, and then we can get to you guys and give you answers as fast as possible. But here, either way, we did put our contact information so you guys can reach out to us. We love having one-on-one time, especially if you have a lot of questions or anything comes up to mind. On those one-on-ones, our goals are basically to see and uncover what are some of your pain points, what are some of the things that you guys are struggling with. And maybe if you have scenarios, we can go in like into the nitty-gritty details of a particular scenario. For some of you that may already have something in the pipeline and you have something that maybe some other lender like couldn't make it work, we can always take a look at it. It's always good to have a different pair of eyes. Take a look at the scenario. But I think the real learning always happens doing the actual things that we talk about and not just talking about them. So we're more than happy to schedule one-on-ones with you guys and take it from there. I am so excited that we got Zoom, okay, because that Lifestyle One app, I love it, okay. But we need to work on it being more interactive and not so like monotone. We want to make it, like this where we can interact with you guys, see your faces, not just kind of live that you see the little, pictures of everybody. But in this point today, good morning, good morning. Today, we're going to be covering it and wanting to make this more interactive. So we want you guys to be unmuting yourself and talking and like that. We're not just like talking by ourselves here. Okay. So without further ado, I think we could get started now. So the goal for today is to talk to you guys about why it's so important to pre-qualify your clients, okay? The goal is not to make you guys loan officers, right? You guys have a huge plate with a lot of things that you got to do as realtors. This is just to sharpen you guys up. So when you're having these conversations with clients, you're providing value. And at the same time, you're not steering away from like the uncomfortable conversation of, hey, if you're not buying cash and you're going to be financing, you're going to need to understand how that works. And I'm here to walk you through the process and make it less scary for them, right? So Johnny's going to cover basically income, credit, and assets and how we talk about it. And then feel free to ask questions here as we go. And if anybody wants to just unmute and ask a question, feel free, okay?
Thank you, bro.
Yeah.
Good morning, guys. Thank you so much for joining in today. Please, guys, let's make it interactive today. We've been doing the same training for 60 days now, 2 months,
Yeah,
a little
2 months.
little more than 2 months. We want this training to be for you guys. This training is not for us. It's not for Lifestyle as a brokerage. This space is for you guys. This is a space for you guys to be uncomfortable, right? Because in this business, we got to learn how to become comfortable for being uncomfortable. So thank you for those that have turning the cameras. For those that have the camera off, unless you're in the shower or unless you're in pajamas or things like that, guys, please go ahead, turn in the cameras. We want to see your faces. We want to interact with one another. Thank you so much for doing that. So without further ado, I think this is very important in this type of trainings to always introduce ourselves so that way you guys know who we are, what we do, and why we actually what we different from other competitors, why we different from other lenders, right? Because at the end of the day, as a consumer, there's a lot of realtors, a lot of real estate agents out there, right? And I think it's very important for your clients to really determine why they should pick you, right? So hopefully for the ones that we haven't been able to, get to meet you guys, get to work with you guys, get to know one-on-ones, hopefully at one point and another, over time, like any relationship, we're able to earn your business, earn your trust, and then start there. So without necessarily more introductions or more fluffiness, my name is Johnny.
My name is Dario.
And then we're 2 loan officers working as one from Buy City Lending. Okay, Buy City Lending is actually our team's name, guys. The bank that we represent is PRMG, Paramount Residential Mortgage Group. Paramount Residential Mortgage Group has been in business for 20 years now. They specialize in mortgages and mortgages alone. So we always like to introduce the bank that we represent because it's really important, right? And it's really important for you guys to understand how does the bank really works in a sense, because PRMG is a broker channel. It means that every branch manager runs and operates their own branch. And in a sense, they are business owners. They operate their own branch. So we have about 300 plus branches around across the nation. We originate loans in 49 states, and we happen to be in the Dayland Difference branch, which is number 4 in the nation. Okay, this is not to brag about us, or it's not about us as a team.
Right.
But I think it's very important for you guys to understand who we are, what we do, and what's the value that we bring. Right. So we've been doing these trainings for now 2 months, a little bit more than 2 months, and we always like to equip our agents with understanding the basics of pre-qualification. Okay, there's a difference between pre-qualification and pre-approvals. Okay, pre-qualification it means that we're having a casual conversation with prospects, right? Prospects means it's somebody that has the idea, has the thought, has the one of buying a home, right? And if they're not buying cash, like Dariel said, they're gonna need to understand financing, right? Because you guys want them to get a loan, we want to give them a loan, but eventually, in this business, we learned that everybody wants to buy a house. Not everybody can qualify to buy a house, right? Everybody dreams about home ownership,
Right.
but it's not easy, right? So our job in this trainings is to equip you guys to really understand the timelines of your prospects, really understand if they're ready, willing, and able, which is something that you guys learn when you guys got your license, right? Being ready, willing, and able. Ready means, hey, I'm as your realtor who is going to equip you, help you, and guide you, grab you by your hand to help you get the loan that you need because you're not buying cash. I have a team. That should be your number one pitch in this business. I have a team. I'm not alone. I not only have lifestyle on my side, but I have a team of lenders
Right.
that can really help you to get the loan that you need, right? So that should be your number one priority when you're speaking with prospects. Now, understanding financing a little bit when it comes to the pre-qualification aspect of things is understanding the 3 pillars that Ariel covered. So I want you guys to write it down, because the more that you write it down, the easier it becomes for you guys to explain it, right? Some of you guys maybe own a home already. The ones that are still renting, I will challenge you guys to give us a call and do a pre-qualification with us on your own. Because the more you understand it for yourself, the easier it's going to become to explain it to somebody else, right? Nadia and I are very big on convince people, right?
Yeah.
Like if you're not selling yourself on the finance and financing aspect of things or buying a home, what makes you think that when you're speaking with somebody, when it comes to buying a home, is going to make you feel comfortable to have that conversation with somebody, right? So there's 3 pillars that we cover all the time in our trainings. Income, so write down income, credit, and then in parentheses right next to credit, I want you guys to write down liabilities and credit score, okay? Because credit is two things. We need to know credit score, and we need to know also what type of debt, what type of credit liabilities does this prospect has, so that way they can understand that there is a relationship between how much money you make, but it's also how much money you own, right? Especially for first-time home buyers. We always say, listen, toys, especially in Miami, it's kind of hard to tell somebody don't buy the toys yet until you buy your home. But it's a true statement. Before you buy your toys, buy the house. Once you secure and lock in your house, then you can buy the toys. And the toys are like cars.
And practically anything. I know people that are renting and they have a boat, an RV, a side-by-side, and like 2 cars.
Right.
You know what I mean? And I'm like, you combine all of that, that's like a big mortgage.
Yeah. So some people actually have a house already, but they're on the go. It means that they have a bunch of toys and they still renting, right? So before you actually buy the toys, buy the house. Now, the other thing is, so we have income, we have credit. Underneath credit, you have credit liabilities and credit scores, and then we have assets, right? Just so you guys can have a little bit of background of how long have we been in the industry, in the financial industry, because just so you guys know, real estate and mortgages is part of the big umbrella of the financial industry. Daria and I have been in the financial industry for 8 years, and in total combined in sales and working in sales, service, and the people business, 15 years, guys. This is going to be our 15-year working on the people business. So again, it's not about us. It's just trying to get you guys into this idea of, before you actually get dedicated 100% of your time of learning real estate, for those that are in the room and they're new licensed agents, or maybe your production is not where you want to be, try to get in the habit of learning the psychology of sales, and don't get caught up too much on the technicalities of real estate, okay? Because real estate is something that you learn with experience. Go out there, talk to a lot of people, so that way you go through real scenarios, and that's what's gonna get you to be a better realtor or real estate agent, right? Assets is just a fancy word, guys, for savings, right? How much money do you have put away to be able to cover down payment and closing costs, right? We all know that when you buy a house, those are two things, and which are major aspects of the financing process of buying a home, right? Because income, we can help you figure it out, right? We can always give people a plan of, hey, have you ever, think about outgrow your career? Have you ever think about maybe getting a different job that gets you, a more income?
Or adding someone to the application.
Adding somebody to the application.
Remember, by us being a bank, guys, we have a huge many of a ton of different programs. And some people are like, what options does that give me as a buyer? It's basically the fact that we can get very creative on how to get you the loan, but none of this would be necessary if you don't have the money saved to put down payment. If you don't have down payment money, or for closing costs, any kind of money put away, it becomes very difficult. It's an uphill battle. And yes, we've all heard of down payment assistance programs. Guys, if there's anything that's free from the government, look at it like 3 times, okay? Because it's very difficult to obtain. And can it happen? Yes. Do you, as a real estate agent, even want to be focused on helping people that don't have money to get a house? If you want to open up a non-for-profit, hey, by all means, I'll be one of your supporters from afar. But if you're here because you want to change your family's trajectory financially, you want to be able to leave that job that you hate, and you want to produce money, I would be focused 100% on people who have money. And guess what? One of the big things that we've uncovered is that if you're prospecting, okay, with people who are already homeowners, this helps you because chances are if they've owned their house for 2 or 3 years, they're going to have some equity. And then you could use that as check. We got the assets part. They got money, right? If you're like a first-time home buyer, that's one of the very first things. Hey, in Spanish or in English, like, ¿cuánto dinerito tienes ahorrado para lo que sería down payment? ¿Me entiendes? How much money do you have put away for down payment or closing costs? Or if a lot of people, there's a million ways to ask the question. How much money have you set aside for this investment or this transaction? You just want to uncover how prepared they are, because you don't want to be investing a lot of time with people that just don't have that part. That is, out of the 3, income, credit, and assets is the deal breaker,
Absolutely. So again, income, credit. With credit, you have credit score and liabilities, and then you have assets, which is another fancy word for savings, right? A good strategy that we actually implement when we're speaking to prospects that wants to buy a home, or in anything that has to do with sales, is before you guys ask the question, give an explanation of what the question is going to be. So for example, if I need to know how much money do you have put away, it could be a little bit uncomfortable, especially when you haven't built enough relationship with your prospects, right, to ask that question. If it's somebody that you really know closely, right, if it's in your sphere of influence, a close family member or a close friend, that is basically an easy question, right? How much money you have put away, right? But when we're working with the consumer and when we're working with cold leads or people that we maybe don't have a close relationship, the best strategy to implement is explain down payment and closing costs, right? So, hey, one of the things that we're gonna need is down payment, explain down payment. Another thing is closing costs, explain closing costs. There's different ways to go about it. When Daliel and I are doing pre-qualification calls, it's very simple. Down payment is an investment, right? Look at it as you open a savings account, and instead of opening a savings account with no money, you're gonna open it with some money, right? The down payment is an investment that you're doing on your home. It's a good faith deposit. It's a good faith for the bank to be able to lend you the majority of the cost of the home. And closing costs, everybody pays closing costs, right? The seller pays closing costs, the buyer pays closing costs. It's just the cost of you getting a loan, right? Because if it was free, everybody will have a home, right? Does that make sense? And they do temper checks, right? Does that make sense? Are you follow me? Do you have any questions? No. Well, now that we actually have, that we have determined that you're going to need some money to buy a house, more or less, how much have you been able to put away, right? And how long have you been saving, right? So income, credit, assets, right? So let's break down one independently. So income, right? So there's actually, I learned this the other day. There's three type of individuals, right? Somebody that has a job that is in payroll and it gets a W-2 form at the end of the year, right? For those who are not familiar with the a completely different thing, right? So when you're in a job and you hired by an employer, you get a W-2 job.
Okay, internet connection says a little unstable. Can you guys see us now? Did it unfreeze? Okay,
cool.
good.
So that's basically the number one one example of an individual, right? An employee who works for under an employer and gets a W-2 job, get a W-2 form. The second one is a self-employee / business owner. It's all both treated as the same. What does a self-employee mean? Somebody that is not under a payroll. It could be somebody that it gets hired with a 1099 form. It's another form, guys, not a W-2 form, 1099 form, commonly known as a self-contracted individual, self-employee, right? Independent contractor, right? They're all the same. Some of those people get a 1099 form, or some of them, they just get direct deposit to their bank. Those individuals are the ones that they get paid on front, and at the end of the year, it's their own responsibility to pay Social Security, federal taxes, state, county taxes, et cetera, et cetera. It means that they don't get any deductions out of their paycheck, right? They get a direct deposit or they get a physical check. Believe it or not, guys, we'll still get physical checks.
Yeah.
And then the other ones are business owners. So what is the difference between a self-employed and a business owner? Very easy. It's a business entity, right? So the best example is you guys. You guys are real estate agents who are subcontracted by a broker, George Cansovello and Lifestyle International Realty, subcontract you guys because you guys have a license and you guys get paid as a 1099 employees, right? Now, George Cansovello will be the example of a business entity, right? He owns Lifestyle International Realty, and then he is a business owner, right? Business entity versus not business entity. All you guys have to remember is that self-employed business owners' income gets calculated exactly the same. Average last 24 months, right? On the W-2 world, we actually calculate gross income, and then there's different method of payments. Some people get paid salary, some other people get hourly, right? Two different ways. Two things that you guys have to understand that they have in common. Agent for less than a year now, or a year. You just made your mark to a year to be a 1099 employee, right? That is 1 year work history as a realtor or real estate agent, but you had a job and you work in that job for 3 years. So how many years of work history do I have, Dailet Herrera? Unmute yourself, please, and tell me how many years of work history do I have on that example?
I'm sorry, you're frozen.
Oh, so the example again. So 1 year, you've been 1 year as a real estate agent. Yeah, but you have received your 1099 already, 1 year real estate agent. And before you used to work at the mall in a retail store, and you had 3 years there as a W-2 employee. How many years of work history do you have?
4.
Very easy, right? 4 years work history. Do I need to be in the same industry? No. The only loan program that forces you to be, not forces you, but requires you to be in the same industry is the FHA loan, right? And guys, FHA is not a first-time home buyer loan, okay? Does that make sense? Everybody follow? Good, good. So 2 years work history, not in the same industry, just overall 2 years work history. Another thing that we get a lot, that we see a lot of confusion is if you're a W-2 employee, right? So remember the example, retail store, 3 years W-2. Now you left that job, you quit that job, and now you're a full-time realtor. You have 1 year of 1099, right? 1099 requires you, 1099 business owners require you to have a 2 years work history as a self-employed and business owner. So if you have been in the real estate arena and then you get a 1099 for 1 year, how many years do I miss to be able to qualify for a loan as a business owner, Karen?
One more year. Mhm.
Perfect. Right on point, right? It's a little tricky, but it's not difficult. Now, where does the difference comes from? If you're a 1099 real estate agent and unfortunately you decide, hey, I tried it, I give it my best, and I'm gonna go back to my right? I'm gonna keep hold my license, but I'm not gonna do real estate anymore as a full-time agent. I'm gonna keep it, but I'm gonna go back to my job. I get hired in my retail store again, right? As a W-2 job, right? In this example, can I now apply for a loan? Melissa.
I would say yes.
Correct. Correct. Why?
Because you had the time in real estate plus whatever time that you previously had counts towards it, and you went right back to the retail. So therefore you are again on a W-2.
Right on point. So guys, that is the only way you can actually apply for a mortgage loan coming from a 1099, going back to a W-2 job, as long as you're not in a probation period. A lot of lenders don't tell you this. They just say, yeah, you pre-qualify your client, I'm gonna help you, this and the other, but they don't give you the hints behind. Dariel and I always think like underwriters. Why? Because guys, your clients will always be your clients. Your clients are not our clients. You guys are our clients. So we have a better relationship with you guys to make sure that you guys look like superstars in front of your clients. Because if you guys look like superstars in front of your clients, you're gonna love us. It's just, nature, common nature, right?
Right.
So 1099 business owner requires you to have a 2-year consistent. Why? Because the way banks calculate that income is in an average 24 months. So if you have 1 year, can you calculate average 24 months of income, Marielle?
Hi, are you frozen the last part?
Okay, so if business owners and self-employees, the way banks calculate your income is an average last 24 months, and I have 12 months
Yes.
of
2 years.
You need 2 years, right, to calculate income for self-employees and business owners, right? If I have 1 year, can I calculate average 24 months?
Depend is the before is the same line of work.
Okay, so just to be clear, the answer is no, we cannot, because you need 24 months, right? The key component is you need an average last 24 months of income history. And if you have 12, it means that you're missing 12 more, okay? We wanna make sure that this is very clear for you guys, right? Now, this is not for you guys to tell your clients, hey, you don't qualify. That's not that's not what we're going through these examples. It's for you to guys have the better understanding on how is it that banks calculate that income, but don't tell people you don't qualify, because one of the key benefits that we offer is that we have all loan programs that you guys can imagine. Okay, this is for you guys to have kind of like a how do I explain this, like
To have a
detect
guide,
recollection.
you want to
Yeah.
have some kind of guide, right? And you want to create that interest to make
Mhm.
sure that like one thing I see very common is, especially when we're new into an industry, we want to say everything that we
Mhm.
know, right? It's kind of like the doctor example, and
Yeah.
we talk about it all the time, that a doctor only gives you the information that's needed, so it's because they provide value to you, and you kind of gotta like hold them in the arm before they leave the room. They're in and out. And the more curiosity you provide, the more they need you. So
Mhm.
don't give up all your value up front for free. Okay. Always maintain curiosity to your clients. You want to keep them like curious, like, oh, wait, every time I speak with her, she gives me value, but I have another question. Okay, good. I'm here to help you. That's kind of the theory that he's trying to say. So when it comes to income, guys, you just want to know generically what you have in front of you, right? Let's break it back down to the basics. Do you work for yourself or do you work for someone else? If you work for someone else, how long do you have a 2-year history? Perfect. If you work for yourself, do you have a 2-year history? It's the same question. You're just asking to get generic information. You want to understand where your client is at, right? You want them to paint you the picture and tell you the story. So like that, when you call us, we know, okay, more or less where their income is, more or less where their assets are, and more or less where their credit is. With those 3 pieces of information, we're going to take it one step further, right? And then we are always going to maintain in contact with you guys, so you guys know. I do want to open up the room to some Q&As. If anybody has any questions so far, maybe a specific scenario or something, so we can all kind of brainstorm about it. Feel free to unmute yourself. Hello, Zoe, how are you? I think you're still muted. We can't hear you. Although I don't see the little mute thing on, but I couldn't hear you speaking. Yeah, we can't hear you. Anybody else that may have a question? Okay. What is the best way to meet with us? Is basically on a one-on-one setting. We could either have a phone call or meet in person. Kind of so you guys know more or less our schedule. We're like all over the place.
Frozen again.
I can't hear anything.
They got off, so I'm pretty sure they're gonna log back in.
Thank you, love.
Can you guys hear us? We're back. Everybody there? Can you guys hear us?
I hear you.
Awesome, perfect. Sorry. So we connected here closer to the Wi-Fi. Hopefully we don't get any more interruptions. I believe Zoe, so you were asking what would be a great way to meet us. So typically on Mondays and Fridays, I am in the West Palm Beach office. Tuesdays, I am in Fort Lauderdale. Johnny is in Pines. Wednesdays, typically, I'm in Aventura and Johnny is in West Palm Beach. And then Thursdays, I'm here in Miami Lakes. And Friday, back to West Palm. And Johnny, like, we can make ourselves available. Zoom, I think, because we're all over the place, unless you happen to be in one of these offices, Zoom is probably the easiest way. We do a one-on-one. We, talk about general things. We want to make sure that we can cover as much as possible. If you guys have any questions, or if you just want to talk about goal setting, or if you want to talk about, high level, like what are some of the things that you see that are successful. We have a privilege and we're humbled to work with some of the top people in lifestyle and some really top producing agents outside of lifestyle. So we can learn and understand what they're doing that's successful and show you guys so you can see how it works. You know what I mean? We've seen people convert from part-time to full-time. We've seen people leave their jobs and then become successful. There's so many different ways to be successful in real estate, and we'll be more than happy to sit down with each of you individually to see where you're struggling and see if maybe we can help you in that area, okay? Any other questions that anybody may have?
I have a question for you. Right now, I'm on disability and I'm on Section 8, and I got into real estate because I'm tired of living this kind of life. I should have done it a long time ago, but you know how it goes. But I just recently got my license, and one of my goals is I want to get off of disability and Section 8, but I want to also get into a home, like find what I need to do or what my qualifications would be or whatever the case may be through you guys. So I know what I need to do and work on in order to be able to say, okay, now I have the means, I know what I need to do, I'm doing it. And once I get it done, I can get into a house. How does that work for someone like myself?
Right. So the beautiful thing about real estate is that, guys, you have a humongous opportunity. Like, you could be 2 transactions away from changing your life, right? I think you want to be able to balance 2 things out, okay? Having consistent income, one, and having, large sums of commissions every now and then or periodic. I think a great opportunity, if you're in South Florida, is do rentals. That's the easiest way to make consistent income. Okay. And feel blessed, because there's other states, there's other cities in the state of Florida that you cannot make money from rentals the way you do in South Florida. Okay. So
Right.
if I was in your shoes, I'd focus on trying to get a sale at least once every 3 months. Okay. A sale once every 3 months, and at least 2 to 3 rentals per month. So now you have consistent income and you have the ability to get some nice chunk of cash every now and then. Now, what's that? The availability that's going to give you is it's being as financially responsible as possible. You want to make sure you save up money. Guys, there is so many ways to get a loan. If you can have consistent income, you can pay a mortgage just like you can pay a rent. And if you get these, big commission checks every now and then, and you plan yourself to have money put away for taxes, and you know what that percentage looks like to save, you can save a large sum of money pretty rapidly. And now you don't have to go and tell us, hey, Johnny, Dario, like, do I have to get a traditional FHA or conventional loan with the 2-year history, blah, blah, blah. Guys, you could get a hard money loan. And as long as you got 30% saved, which is actually realistic, I've seen people do it over and over and over again, there's no reason why you can't get a house. Now you get a private loan from an investor, and now you live in it for some time. And every single property I would focus on, thinking that my first property is going to be my first investment. And the easiest way to get more purchase power, okay, and be able to, as long, remember, assets is the #1 key. You got to have the money put away. But the fastest way to get more income to be able to get a bigger property is getting a multifamily. Okay, if you get a duplex and the second, like the second section of the house, you can collect rent. I'll give you an example, $2,000 per month. We could count 75% of that as additional income on an application. Okay, you can also do a way where you're buying the place hard money and then you're doing a refinance afterwards that you don't have to prove your income. We have programs for that, and you can rent the property out and make money out of it. But I think that the hardest part is to a set number of down payment money as fast as possible. And I know it seems like a huge task. Like how in the world can I, if I can even make 100 grand this year, how can I save 100,000? You know what I mean? 100,000 seems like a humongous number. You just do it one sale at a time, There's, multiple different ways to do things. I think that the hardest part is going to be saving that money, as much money as humanly possible. And I think if you have a goal, and you work really hard towards it and you surround yourself with like-minded people, it becomes more real over time. I wish there was a short way to answer that, but I think consistent income with rentals and periodic big commission checks from listing a property or helping a buyer buy a property, that's where it's going to change your life. I've seen people come in here, from a part-time job or even having a job that, they hate. And then they come here and they're just, the pain of being in their current circumstances more than the pain of being uncomfortable and doing the things that you need to do to be successful in real estate. And they get some insane level of motivation. And before you know it, I've seen a realtor make 100,000 his first year and save 50% of it. You know what I mean? And paid some taxes and saved money. That's another thing. Like, I personally wouldn't be so focused on declaring a lot of income and paying a lot of taxes. That's just me because I understand how loans work. I would be focused on paying as least amount of taxes as possible and being able to get a realistic loan. Johnny, I don't know if you want to input on that. What would be your opinion?
That's basically it, guys. The only thing that I will add there is, nobody wakes up in the morning and plans to fail. Right? Nobody wakes up every morning and say, I'm gonna fail today. I think as humans beings, the biggest mistakes that we make towards our goals, financial goals, is we fail to plan, right? So if you have a goal, which is buying a house, most people don't accomplish it because they fail to plan, right? How does it look like when it comes to planning? Have a budget, right? That should be your #1 thing, right? Do you have a budget, right? Can you cut down expenses that, will create habits? Bad ones are good ones, and it takes time to break the bad ones. So as it takes time to build the good ones, right? So look at your finances. A lot of people, when we're speaking to people, they say, well, I don't have the ability.
AJ, close the door.
I don't have the ability to save money, right? But then we ask deep questions. Okay, talk to us about your expenses. Okay, how much money do you need every month to live by, just to pay your bills and have a little bit of entertainment? Because guys, nobody's going to cut down, make big changes in a matter of seconds. It takes time. It takes time to build those habits. But oftentimes when we're speaking with people and we ask deep questions in regards to their finances, so there's people out there that make 10 grand combined income, married couples, 10 grand a month, and they have no money put away. And guess what? They only need $4,000 or $5,000 to live by. So that should tell you, you have the money, you make the money, you're just blowing out the money, right? So the #1 thing is just have a plan, create a budget. And then once you have a budget in place, cut down unnecessary expenses, but don't just cut down your expenses or cut down the things that that you're not supposed to be spending money on, and then add that money to another expense, right? Create a savings account, accounts that you don't have access to, right? Nowadays is really, challenging to accomplish financial goals because of technology, believe it or not. It's in the palm, it's in what is it?
In the palm of your hands.
It's in the palm of your hands.
It's easily accessible.
And then that's why it becomes a challenge to actually put money away, right? So have a plan, have a budget. thank you for sharing your scenario, Melissa. I love the fact that you actually share your story, share your situation. Kudos to you on that. Don't look at the past, look at the future, right? Sometimes we say, hey, I wish I would have done this long time ago, but it wasn't your time back then. Now is your time. So focus on your career moving forward and implement the things that Dario said. In regards to the loan programs, guys, listen, we as a loan officers, we're the ones who are actually going to guide your clients in regards of the best loan program based on the specific scenario, right? I can tell you how many times we have been able to show with real numbers to people that FHA is not the best way sometimes, right? It depends on each individual, right? Sometimes FHA is the only way, right? But when you compare an FHA to a conventional loan known as Fannie Mae, Freddie Mac, which is the two banks, conventional banks, sometimes with numbers, you are able to show people that FHA is not the most cost-efficient way. Conventional might be the best way just because of a mortgage insurance. Mortgage insurance is required when you put less than 20% down payment on both loan programs. Mortgage insurance is more expensive for an FHA loan than a conventional loan. So based on your question, Zoe, we're gonna give you the answers, but not every time not all the times is the best loan program for everybody. This is not a one shoe size fits it all, right? Yeah. It's like peeling an onion. We got to do a lot of more work to understand the specifics of that scenario to be able to recommend something to your clients. Look at it like the doctor example, right? I don't know when was the last time you check on a doctor, but it's always the same process, right? Somebody comes into the office, they ask you a bunch of questions, right? That person leaves, typically is the assistant of the doctor or somebody that is in school to become a doctor. They do or a nurse, they give you a pre-screen, they take your vitals, and then the doctor comes in and immediately gives you a recommendation? No, the doctor also asks you a bunch of questions and then at the end prescribes you with a recommendation. So with a loan is exactly the same. We got to understand more details about the scenario, but for a conventional loan, the difference between conventional and FHA is that conventional, if you qualify conventional, 9 out of 10, you always want to go conventional. Why? Mortgage insurance is cheaper, right? Two things that you want to have in mind is, let's continue with the training. I'm sorry, we went out of topic, right? Credit, right? Credit and liabilities, credit and credit scores. Guys, minimum credit score for FHA is 580, conventional is 620. When we're speaking with somebody, right, and they say 580 or 620, you're supposed to be thinking, why is it that your credit score is 580 or why is it that your credit is 620? I see a lot of real estate agents and I see a lot of lenders try to sell this idea to individuals that if you have 580, you can qualify for an FHA. If you have 520, you can qualify for a conventional. Guys, those are the minimum credit scores, okay? So let me give you a perfect example. You're speaking with somebody. They say 580 and then your red light turns on and he's like, oh, perfect. That person can qualify. The word is qualified to apply, not qualified to get a loan. You're qualified to apply for an FHA loan, right? Let's talk about FHA for a second. 580. When Dariel and I are speaking with somebody is, hey, Zoe, is there a reason why your score is 580? Do you have any negative remarks? Have you paid? Do you have any late payments? Is there any things in your credit history that has caused you to have a 580 credit score? We cannot hide from the fact that 580 is a low score. Okay, we cannot hide that a 620 is still a low score, right? So we actually ask questions to understand why is it? Why? Because as lenders, we have the tools to help your clients with credit needs. Right? Sometimes it's as easy as, pay this, pay that, and then that's it. You got 30, 20, 40 points as a booster that can help your client. It's not going to help you or us. It's going to help your client to have better terms on a loan, right? You should be thinking higher the credit score, better the terms, like anything when it comes to financing, right? It's just like anything that you're talking about financing, higher your credit score, better the terms of the loan. So don't just stop there, right? Now, if they say whatever they say, 580 is your credit score, your next clue should be how much money this individual has put away. Because if you're gonna tell me that they're gonna finance 50%, right, or 40% or 60% of the total purchase price, we may have a solution, right? because maybe they just have right enough credit score to qualify to apply for an FHA loan, but they're not looking to finance 96.5 of the cost of the home. In other words,
let me
the
chime in
minimum.
on that. I'm gonna chime in. So I guess for me, my way of learning is seeing examples and real life stories. And because the real life stories, I guess they stick better in our brains. At least for me, it does. What would be a scenario where you have somebody that's putting such a large down payment that happens to have bad credit? Very, very common. You'd be surprised. People getting divorced. Unfortunately, when you're getting divorced, there's combined debts, and people stop paying these debts because their attorneys, their divorce attorneys, tell them, listen, stop, seize any payments, because now most divorces are kind of not good. Okay, most people don't worry, I'm going to pay off all the debt and you can keep the house and we live happily ever after. That's not how it works most of the time. So now you got people that their credits are tanking because they're really like, they stop paying their credit cards that they both owe, or they stop paying the car payments, or and their credits start going like this. But then they sell a house, and now the proceeds of that house are going to be divided 50-50. Oh, I got to take this call real quick. So basically a divorce scenario would be, hang on, John, I'll give me 1 second. All right. So in that case, you have someone that has low credit score that happens to have a lot of down payment money. And that right there is kind of like a realistic scenario. You can cover, I guess, the average down payment. I'll be right back, guys. Yeah.
So that would be a great example for somebody that has a lot of funds, right? To not finance, they're not looking to finance the minimum. My idea here was to let you guys know that you cannot go with the minimum credit score and the minimum down payment, okay? Oftentimes what happens is that, I don't want to go too technical and on this, but oftentimes what happens is that the loan will be so expensive that no bank is going to be able to close that loan. Since after 2006 and 2008, there was a lot of regulations in place to protect us as consumers from predatory lenders. Back then, there was a lot of predatory lenders, and that's why we went through a crash in real estate, okay? There was a lot of lenders who were lending money to individuals that they could not afford a monthly payment for a house, that it was too expensive. There was toxic loan programs out there. And that's one of the big things that causes that crash. So ever since then, there's a lot of regulations in place where even if you have 580 and you have the minimum credit score, oftentimes what happens is that the cost of closing on that loan will be so expensive that there's no bank that is going to be able to do it unless it's private money. Private money is also known as hard money or bridge loans. They create all these names: bridge loans, hard money loans, private loans. Those loans, they can charge you whatever they want to charge you. And if you have the money as a prospect, listen, there's some people that have the money and then you just got to help them to get a house. Okay. That's what we're here for. We're not here to account for their money, to be their financial advisors, their CPAs. You guys have a role, which is get them to actually closer to the goal, whether it's buying or investing in real estate. And we have a role too, which is help you guys to those that need financing. Are we clear? Cool. So on a conventional loan, just to answer your question, so it's 620 minimum credit score, 3% down payment for those who are under the median average income per county. So Miami-Dade, Broward, and West Palm will all have the same average median income, which is $55,000. So if you make $55,000 or less, there's a conventional loan program at a 3%, okay? So guys, just be extremely careful when you guys are listening to the media and listening to lenders advertising, okay? Because oftentimes, us as a consumers, we fail to read the small letters. That is our responsibility as a consumers. Now, your responsibility as a professional is to educate your clients. We're very big on education. When you bring us a client, we make sure that that client is equipped. Why? Because the more equipped they are in the financing process, the less they're going to be confused. And then trust is big. A mind that is confused is not going to make a decision, guys. Okay. So we want to help them understand and provide them all the education on front. So when they go out there, because guess what? People don't make decisions like this when it comes to buying a home. It's a process, right? The statistic shows that it takes 30 to 60 days. It's actually a 60 days cycle to buy a house, right? So chances are that when we speak with them on face-to-face or on the phone, they're gonna speak with a neighbor who is no disrespect to no professions, to the neighbor who's a plumber, right? Giving them advice on how to buy a home, right? And just the plumber is just an example. It's easy for me to say it, right? No disrespect to no profession. I've done a lot of work in this country. I've done a lot of professions, so no disrespect there. So the more you educate your clients, the better. So minimum credit score for conventional 620, minimum down payment, it could be 3 to 5%, right? 5% is typically like all other loans that don't qualify for the 3%. And then money saved, I mean, it is, you always want to make sure that you explain down payment and closing costs. My rule of thumb is 8 to 10% total cash to close. So if you're trying to buy a single family home, 300,000, you want to have at least $24,000 to $30,000. Now, you guys also have to remember the different components. What's another component today? The market. What market are we in, guys? What type of market are we in, Zoe? Is your mic on already? No, we can't hear you. What type of market are we guys in today? We're in the market of sellers, right? Sellers, not sellers, buyers, right? So yes, well, seller in a sense, right? Seller is because I don't think everybody has different opinions. You have an opinion, I have an opinion, but experts, I go with experts. I go with data and analytics. Right now, we're in a buyer's market because sellers are now giving sellers concessions. Anytime you are in a market that sellers are giving credits, that's not a seller's market. Seller's market was before October 2022, all the way back into almost 2021. We lasted almost 18 months in a seller market where sellers had the advantage. They will put the price that whatever price they want to put on the house, and it does not matter about bringing a comparable analysis. It does not matter to bring evaluations about prices around your neighbor. None of that stuff mattered. We were in a seller's market. Today, we are in a buyer's market because you guys are seeing seller's concession. When you are representing a buyer and you're not asking that seller to pay for some of your closing costs for your client, depending on scenarios, right? It could be that the price was listed at the wrong price. It could be that the house has been in the market for over 60 days, right? So if you guys are not asking sellers concessions when you're representing your buyers, you guys are not representing your buyers the way you should, right? Why? Because there's a lot of sellers willing to pay closing costs for your buyers. So going back into the example of $24,000 to $30,000 put away on a $300,000 property, what if that client has $15,000, $18,000, and all they're missing is just their closing costs? We have sellers who can pay their closing costs, right? So it's always having those key components in mind that depending on what market we're in, as long as they are fully pre-approved on income, credit, liabilities, and they have some money put away, it's better to position them in a way where be ready for that opportunity. If the opportunity comes, if I'm able to get you a seller that paid for your closing costs, boom, you just put somebody in a home. Make sense, Zoe?
Before we leave, I wanted to leave you guys with something that I feel like it helps a lot of you guys out. It's basically a little formula and a little skill that very quickly you can identify someone's more or less purchasing power. How many times do you get people asking you, and you're a realtor, but clients, they don't know really, they think the realtor knows it all, in which in most cases, listen, we've been in a room with the top 1% of South Florida, and trust me, they know it all. Why? Because they've been in mortgages, they've been in real estate, they've done a little bit of everything. They've been 10, 20 years doing this. Eventually you'll get there, but in the beginning, it takes time to learn it. And I think this little formula I'm going to show you guys can really help. First and foremost, mortgage calculator from Zillow. Have that as like a super easily accessible that when you pull up your phone, open up the internet on a bookmark, you could go right to it. Because how many people tell you, hey, Daila, Zoe, or Melissa, how much more or less can I, if I want to pay $3,000 a month, how much, like, is that a $300,000 house? Is that a $500,000 house? You know, so you can more or less have a tool that you can be like, yeah, it's more or less. Remember, you want to keep them curious. You don't want to be saying definitive terms either. You want to just say, hey, it's more or less this. You got to give people what they want. What do they want? Some information. Sometimes they, you know, it's an analytical person. They want an exact answer. Well, we got a mortgage lender that will answer that for you. You know what I mean? But in the meanwhile, mortgage calculator from Zillow, have easy access to that. That's the first thing. Second thing, how much money did you make this year? Keep it high level, gross. Do you work for yourself? This and that. Just ask the client, how much money did you make this year? I made $100,000. Let's do that example so you know how to do it. This is the formula. You get total annual income and put it as an example, 100,000. And then you're going to divide that by 2 because that's what the bank's going to do. 50,000. Now you're left with 50. Why divide it by 2? Because you can't make all your income to pay just the mortgage. You need to live. You need to have money for gas, food, everything else that comes with that. So now you have 50,000 that you're eligible for mortgage purposes, right? You divide that now by 12 to get the monthly. Now you got the monthly number. That should be like 4,100 something. Let me see. 50,000. Let me do the math with you guys. Divided by 12. You should have 4,166. Okay. Now you deduct liabilities. You don't have to get super into it, but just ask them, hey, do you have a car payment? That's typically the deal killer right there. Okay. Are you going to be applying by yourself or with someone else? Okay. Because $100,000 could be a couple making 50-50. Basically, we're going to count half of that. If in the ideal scenario, one makes 50,000, the other one makes 50,000, that's odd, but hey, they're out there. Sometimes it could be one makes 80,000, the other one makes 20. You know what I mean? So you got to kind of like, this is just for example purposes, right? So now you're left with that amount. How much is your car payment? Oh, I pay $466 to make it simple, right? Minus 466. You deduct the liability, should be left with $3,700. Okay, let's say they have credit card debt. Guys, I don't go too much into that because that's typically a little fraction of it. And by them telling you your credit score, you'll kind of know, right? Because a lot of your credit score has to deal with your utilization on your credit card. So if they tell you they got bad credit, I wouldn't even go into that so much because either way, what we calculate for liability purposes is only minimum payments, not the total debt. So if you have 5 credit cards and the minimum payments add up to $200, guys, that's not going to be a deal breaker. But you could ask, you know, you could run the example on yourself. How much money did I make total annual income last year divided by 2 divided by 12 minus liabilities? That's kind of the formula. I'll run it again. Total annual income divided by 2. Now you have that number, you divide it by 12, and then you deduct liabilities. Minimum credit card payments, total, car payments, student loans. I wouldn't get into that because most people have them deferred anyways, and we can figure ways around that. Personal loans, things like that. So those are liabilities. And then whatever that number is left behind, hey, what happens with the mortgage calculator? You just plug it in. You put, hey, how much money do you have put away? Oh, I have $20,000. Okay. You basically get maybe 15 of it or maybe 14 of it, and you put it on the calculator as a percentage. 5% is the rule of thumb. You want to always shoot for conventional. So you put on the mortgage calculator, 5% down payment. You put what you know what they're allowed to spend, right? And then interest rate, just plug in a 7 to be conservative. It could be higher, it could be a lot lower. It depends, but always, you know, to have a more or less number on the calculator, you put 7%. You put 5% down payment, and you know how much their monthly payment is. Boom, you get your purchase power. And that's like the quickest little quick way. It's a little trick that, you know, you can do and apply. The more examples you do it, the better you're going to get at doing it. The more conversations you have with us, the better you can get with this. Do you guys have any questions on that?
I know you guys are always talking about South Florida, but what about those of us that are here in Orlando, Tampa area? How does all the percentage and things work for us?
So it's the same, yeah, and basically interest rates are a national thing, by the way. They're not specific to states. Yeah, interest rates are gonna remain the same.
Yeah, and the other
And
thing that you
Melissa,
were talking about is,
go
the other
ahead.
thing you were talking about is rentals here in Orlando. I'm gonna be honest, we
Right.
suck. For rentals, we are not as lucky as you guys. So someone
Yeah.
here, what
Now that you
advice
tell
do
me
you have
this,
for
the first
us?
thing I remember. Yeah, and when you were mentioning earlier, and I was telling you, like here in South Florida, you're lucky that you can make more money from rentals. Now you tell me that, immediately I remembered, oh snap, you're in Orlando. I know I would get together with your branch manager. Are you in the downtown or Lake Nona office?
Lake Nona.
Okay, so get with Jennifer and speak with her. Hey, listen, I want to make consistent income. How do I do that? There's plenty of leaders in the office. You can speak with Omi. He's very approachable guy and he can help you to see how that works. Because I know that you guys rentals are tough up there for you to make money. In the Tri-County area down here, West Palm, Broward, and Miami-Dade, it's a lot more lucrative. Hey, who knows? That might be a reason why, if it's a possibility for you and you're open to moving, hey, I would chase the money, me personally. You know what I mean? But that's just obviously something you need to weigh out. But I would definitely get with a manager and speak to them, have a one-on-one with them, heart to heart, understand where you are, set some goals and go after them. You know, that's basically the principle there.
Okay.
Great question. For the hard money, so basically a hard money loan, Alma, is gonna be a typically a 12-month thing. We don't look at hard money loans as like a permanent solution. This is kind of like a bridge loan. The point of a hard money loan is get the property, right? Once you get the property, now you have options of what you could do afterwards. So typically, just so you have an idea, the average hard money loans about 12%. But they're interest only. So you're only paying interest for those 12 months. And, you know, there's no real guideline for hard money because you're going to an individual. They make the rules. So we, for example, Johnny and I, we have roughly 20 investors that we speak with. Each one is different. Some don't like doing deals under $500,000. Others like smaller deals. You know, some charge a little bit more, some charge a little bit less, depending on the risk. So that's like the wild, wild west of loans, right? Hard money is like, it's a per case, per investor, per scenario basis. But typically, yeah, they're locked in for 12 months. That's your interest rate. It's an interest only loan. And the goal is to if we ever position you guys personally or any of your clients for hard money, we are going to have an exit strategy in place. I'm not just going to throw somebody into hard money loan and say, all right, see you next year. You know what I mean? That's a very risky thing to do as it is. And we're going to make sure that your clients are prepared for what is plan B or step 2, or however you want to call it. Foreign buyers, they let awesome. That, guys, is like, I would be very, very focused. If you are in the market that you know and you're an immigrant, like where he's from Colombia, I'm Cuban. Unfortunately, I'm stuck because you can't get people to do loans from Cuba, but Colombia is actually #1 country that's pouring in by large sums of numbers into the United States. #2 is Canada. Okay, so foreign nationals, if you can focus on that and you have a market and you know people outside the country, it's a very simple loan to do. And we do that. That's actually a government-backed program. It's called a foreign national loan. We could give you guys information about how those works. We have flyers. Just shoot us an email. Johnny put the contact information and we can reply by sending you that information so you can kind of study it and see it, but it's pretty much simple. Johnny, if you want to explain the basics of a foreign national.
Yeah, so LTV, loan to volume, is 70%, meaning that you have to have 30% down payment plus closing costs. You need to have a qualified visa. So we have a visa list. So we want to make sure that they have a visa. Foreign national loans are for investors. It's not for you. You cannot be living in the US, okay? So it's an investor program. The funds needs to be here in the US at least 30 days to start the process of getting them pre-approved. So as long as they have the funds here for 30 days, We only need one bank statement showing that the funds are here for the equivalent of 30% for the down payment. And then they typically get pre-approved. The easiest loan program for a foreign national is a DSCR loan, debt service coverage ratio, which means there's no income verification. The property that they're buying, the rental income that is generating the property becomes the income qualification. So your job as a real estate agent, when we actually get them pre-approved, is to find them a property that the projected rental income covers the total payment of the mortgage, principal, interest, taxes, insurance, and HOA if it's applicable.
I'm writing in here on the chat, guys, so you guys can have it. Debt service coverage ratio. It's it's the easiest loan to do, guys. DSCR. There you go. Imagine this way, guys. What's the biggest problem that most people have is qualifying under their income. You know, you have noticed the majority of today's training has been, oh my God, are they W-2? Are they 1099? Like it's, I get it. It's a little confusing. DSCR is that simple. If your mortgage on this subject property that Mr. Buyer you're interested in is $2,000 and you can collect rent of $2,000 or more, that is the income. The property pays itself. Therefore, we could do the loan. So income is a big check mark. All we need is a rental analysis, a good one, guys. Please don't try to like, oh, let me, hype it up so then he can get more, because that can only bite you in the rear. Because either way, one of those qualifications that when they come do the appraisal, the appraisal guy or girl is going to be basically getting the most accurate number. So don't shoot yourself in the foot when doing a rental analysis for DSCR. But yeah, man, that's a very easy loan to apply for. Like everything, these non-qualified mortgages, bank statement loans, and DSCR loans, higher risk because they have less documentation to provide. Guess what? Higher credit requirements, higher down payment. Okay, everything's a scale. Most people want little documentation on an application and low interest rate and low down payment. I'm sorry, that unfortunately doesn't work. That's just the way it is. So it's like everything. If you have lower credit, then guess what? Your interest rate is going to be a little higher. If you have better credit, your interest rates are lower, right? If you provide more documentation, taxes, okay, then maybe your interest rates are lower, down payments are lower, credit requirements are lower. That's just how banks work. You got to look at it from the perspective of if you were the bank and this client is giving you these documents, would you lend them that money? Mm-hmm. That's a great way always to think of it from that perspective, because guys, we're a long way from 2008 when they used to call them ninja loans, no income, no job loans. And everybody like Oprah, you get a house, you get a house. They were giving them away and look what happened. It collapsed an international economy. So now regulations are so high that trust me, if you're buying a house today, it's because you can afford it. Okay, so great questions, guys. Again, we'll be right back at it next Wednesday. You have all our contact information. Please don't hesitate to reach out. We're here to help. We're very big on helping and educating. I think a lot of people value when there's information, and this is our passion, guys. We love teaching. We love showing people the way. Those who struggle the most teach it the best, let me tell you. So if you have any questions or you want to be able to schedule a one-on-one, don't hesitate to reach out. Okay,
guys, before we go, I'm going to share some highlights of some bullet points that A and I don't follow the noise. We follow the data. Okay, so I think it's very important for you guys to do the same. One of the things that we implement every day is that we actually look at the news as far as what's real data. We don't actually hear just any news channels, right? Because we all know that media, it just creates the buzz and the noise to manipulate markets, and real estate is not the exception. So I'm going to read you guys some data. This was actually, it was from yesterday, but the reason why I want to read you this, guys, is because buyers are out there and they need your help. So there's a lot of people out there saying, oh, like market is slowing down, there's no buyers, people don't want to buy, people cannot qualify. Guys, I hope that I inspire you guys today by reading this to you, so that way you guys can actually pound the phones, do the follow-ups, and prospect, because there's a lot of buyers out there that are looking for good realtors that can help them to buy a home, okay? So this reads, bullet number 1, while daily optimal blue rate lock data show modest signs of early January rebound on purchase locks, refinancing lending remains a challenge despite a full percentage point rate decline since October 2022. What this means, guys, is that refinancing a home is still not a good idea, but we just noticed that by collecting data in the last 60 days, rate locks, which is something that all buyers have to do before they close on a mortgage loan, have a high increase in the last 60 days. What does that tell you? We have a lot of buyers right now in the market. Bullet point number 2, purchase rate locks rose by 64% from first to fourth week of January, sharpest such rise in the past 5 years, guys. It means that in the past 5 years, we have never experienced such a collapse of rise of 64% of people locking in the rates in the last 60 days, guys. In the third week of January, 57% of borrowers locking in rates paid at least half a point as part of permanent buy down, 44% paid at least a full point, and nearly quarterly bought down their rate with 2 points or more. What does this tell you guys? That everybody's paying points for rates, okay? Whoever banker, whoever lender, whoever's broker is telling you that is gonna get you a lower rate of what you actually looking in some other loan estimates, guys, please read loan estimates. If you guys don't know how to read loan estimates for your clients, reach out to us. We help you to understand loan estimates. That's extremely important, because guess what's gonna happen when that client closes and they find out somebody like Darrell and I, which guys, we're gonna find them eventually, all right? And they then bring us those loan estimates, and we're able to educate those clients where we're gonna show them that they pay too much or an absurd amount of money for that rate. Guess who's gonna be in their mind of that client? It's not gonna be the lender, it's not gonna be the appraisal, it's not gonna be the inspector, it's the realtor who helped them,
Right.
okay? Bullet number 3, such buy downs peak in September, October 2022, when as many as 7 in 10, it means 71% of buyers paid a point of permanent buy downs. 4 out of 10 means 43% paid 2 points or more. Again, this is just to show you that everybody's paying points to buy down their interest rate, okay? So don't get confused on that. Overall, borrowers or buyers paid an average of 1.25 points down from a peak of 2.03 points last fall, at an average cost of $4,300 per buyer for the week ending on January 21st, 2023, guys, versus $6,900 for the week ending of October 1, 2022. So when the media is saying rates have gone down, and does not necessarily mean the interest rate, it means the cost of those rates have gone down. That's why we have a surge of buyers in the market again, and we're gonna continue to see those as we continue to move on 2023. The last one I'm gonna read you guys is, additionally, at least 3% of purchase borrowers, meaning buyers, received a temporarily buy down with a 1-to-0, 2-to-1, 3-to-1, the most prominent market offerings, setting up some of the degree of potential for payment shocks down the road. What does this mean, guys? Again, sellers giving credits to the buyers to be able to buy down the rates. That's all it means, okay? So guys, follow the data. Don't listen to the noise. Get out there, get fanatical about prospecting people, create relationships, and learn from real scenarios. We don't learn this business by reading a book or coming into trainings. That's not how it happens, okay? So I hope you guys have a great rest of your day. Hope that we brought enough value to you guys, and we'll see you in the next one, okay?
Have a good one, guys.
Thank you.
Thank
welcome.
you.
Bye-bye.